Hello? Yes. Alright, thank you.
Yo, what is it?
Guess what?
Yeah.
We got Magna International. That's awesome!
Awesome, yes!
The first thing in our audit would be to gain a good understanding of the client and everything that goes along with the client, like its competitors, and everything that has to do with the client's industry as well. First, we'll start off with some analytical review.
Magna is an international automotive company based in Aurora, Ontario, with over $28 billion in sales and 120,000 employees. The company supplies the big three auto firms in Detroit and firms like BMW in Europe. It uses the U.S. generally accepted accounting principles and the American dollar. The company requires human talent such as engineers, raw materials including propylene and metals like iron, copper, and silver, as well as utilities for its manufacturing. After a decade of quick growth, it appears that Magna is maturing as a company as management is not so optimistic about future growth potential. This is Frank Stronach, and despite being retired, he still has millions of dollars of business with the company.
So, now that Steve has clued us into the background of the company, here are some quick main points about the industry. The pricing in the industry is in a slightly negative condition. Its most prominent problems include excess capacity, higher cost of goods sold, pricing pressure, and currency exchange rate volatility. Thankfully, the demand is still increasing in all places except for Europe, so the industry itself is growing by around 4% per year. An important legal regulation is the Automotive Parts Tariff Removal Order, which allows for no customs or duties to be charged when auto parts are imported from the United States, processed, and then exported.
Alright, so I've done some basic research on the company's financial state. To start off, their liquidity has been steadily decreasing since 2010. Their cash on hand has been constantly going down, and their fixed assets have been constantly increasing by a good couple of percent per year. Also, the company has been taking in more debt year by year, which is shown in their increasing debt to equity ratio and decreasing current ratio since 2010. Okay. In terms of relation to the industry, Magna is doing quite well as of late. For example, the industry's earnings before interest and taxes was actually projected to decrease slightly in 2012. However, Magna's earnings before interest and taxes increased by almost. This increase in performance is shown in the price of shares and in earnings per share. The earnings per share in 2010 was actually negative for the company, but in 2011 the earnings per share jumped up to $4, and in 2012 it jumped up to $6. Also, the stock price increased by 87% alone in the last year to a current price of $86 on the TSX. Magna International is currently a hot company in the trading marketplace. It has shown steady growth in profit-related areas, which is shown in their profit margin and in their efficiency ratio.
So Adam, what are high-risk accounts?
The high-risk accounts that we have identified are sales and receivables, payables, inventory, and goodwill.
And why are they high risk?
Well, to start, goodwill is high risk because it is an intangible asset and it is hard to value. On top of that, it now might be revalued every time that it is impaired. Sales is risky because management might try to overstate sales to make their company look better by falsifying records. Similarly, they would want to overstate accounts receivable and they would want to understate accounts payable. Lastly, inventory is risky because there's currently an overcapacity in Europe.
So Adam, what are the low-risk ones as well?
Well, we've flagged quite a few accounts as low risk. We have deferred tax assets and liabilities, prepaid expenses and other expenses, bank indebtedness, income taxes payable, long-term debt, other long-term liabilities, and accrued salaries and wages.
And why are they low risk?
These accounts are low risk because they are less likely to be materially understated, because third parties are involved and they have a strong interest and the capacity to follow up on any discrepancies. Okay, Steve, let's move on to inherent risks now. Which inherent risks did you find?
Well, I found that there was 2 ongoing lawsuits right now, but neither of them provided enough credible evidence to question management's integrity or suggest a possible contingent liability. Furthermore, there's an ongoing antitrust investigation in Germany, but from past experience, Magna has not been found guilty of these before, so we have no reason to suspecting higher inherent risk.
Okay.
And have you found any?
Yes, I found that Magna's operations in Europe have a certain amount of inherent risk attached to them. This is mainly because Europe is in a volatile economic condition, and as well, most likely there's an overcapacity in Europe right now. Okay, so now to summarize our risks, we are going to proceed on the assumption that control risk is low based on the previous auditor's report. We will set
Audit risk to medium.
audit this firm, and we will set inherent risk to medium because although we have identified several issues, none of them are major issues. Finally, we will also set plan detection risk to medium because this is just based on the combination of the other risks. Inventory is Magna's third biggest asset account, so it is very important. We have set the performance materiality at $20 million. First, we will go over Magna's cost accounting, including verifying and checking for accuracy all amounts that make up cost of goods sold. We will also make sure to observe the inventory count at the end of the year in as many places with as many auditors as possible. We will check the tags, shelf to sheet, and sheet to shelf to verify occurrence and existence, as well as keep our eyes out for obsolete inventory to check valuation.
Objectives for the audit of accounts receivable and sales is to verify the occurrence of sales and to verify the existence of accounts receivable. To accomplish this, we will send confirmation requests to their clients with outstanding accounts and compare sales invoices for the current and subsequent year.
Nice to meet you too.
Welcome to our facilities. I will show you our inventory and tour.
That's great. So what is this tool?
This is tool B, and it costs $40 million.
And how are you recording the development costs?
The expenses are development cost and on the per unit basis.
On a per unit basis. Why are you doing that?
This is because we will not get the reimbursement from our clients.
Okay. What is this tool?
This is equipment A.
And how much does it cost?
It costs $200 million.
Okay. And how are you recording the cost?
We capitalize it.
Why are you capitalizing it?
This is because we will get the reimbursement from our client for the development cost.
Okay.
Okay, Adam, so for those 2 tools that we saw back in the factory, I'm convinced that they exist as recorded on the balance sheet, but I'm not sure about their classification. I'm worried that we're just taking management's assertion that the contract gives them the right of ownership for tool A, but not for tool B. What do you think?
Well, I think we should look more closely at these contracts. A good step would be to find an industry expert within our firm who could advise us on this issue.
Oh, that's a great idea. I know just the guy. I'll send him an email right now. Hey Adam, so I heard back from our expert. He says everything checks out and that there's no misstatement.
That's good news. That means that we can proceed with our audit.
We use professional judgment to set performance materiality for the cash account at $1 million. As well, the objective we set was to verify the existence of cash accounts because any misstatement there could be very material. To gain sufficient evidence, we are going to check for mistakes on cash transactions and other cycles, review bank reconciliations on a quarterly and yearly basis, and send out confirmation requests to their banks.